Thank you so much, Tanya. I really appreciate that. We have a wonderful panel for everyone today. We're going to be talking about GP and LP communications. And specifically, we're going to be talking about how trust can be established between the GP and the LP and how that can be maintained throughout the deal life cycle. Critically, we're going to be talking about how GP-LP cohesion has fared during times of crisis. And finally, we're also going to be talking about the role that technology is playing in helping advance the GP-LP relationship. My name is Eliot Hodges. I am the CEO of Anduin. We're a private market technology company working together with fund managers to reimagine the private markets. Before I introduce our wonderful panelists or have them introduce themselves, I just wanted to remind the audience that we have a polling question available to them, and we'd love for them to vote on whether in-person meetings will ever make a return to the deal cycle. And we promise to reflect those answers back to you before this session is out. With that, I want our panelists to each introduce themselves. Alison, why don't you kick us off, and then we'll have Kamal and Steve join in after that.
Sure. Thank you, Eliot, and thanks to Informa for organizing the panel and inviting us to participate. I'm with FMO. It's the Dutch Development Finance Institution. We're investing in emerging markets globally with a committed portfolio of over 9 billion euros. About a third of that is in equity, and about 2/3 of the equity is in private equity funds, although we're growing the direct portion both through direct investments in FIs and energy, and through co-investments alongside our fund managers. My personal responsibility is for private equity funds and co-investments focused on Africa and Latin America.
Great. Kamal?
Good morning, everyone. Good afternoon, good evening to everyone joining from various corners of the world. I'm Kamal Suppal, Chief Investment Auditor for Emerging Markets Alternatives, which is a Boston-based firm that specializes in independent research and due diligence of alternative strategies. For LPs, we provide independent due diligence and research when they're short on time and resources. To GPs, we also provide proactive due diligence, which we call investment audit, to help LPs get a head start on their due diligence, thus fast-tracking the capital raising process for GPs. Today's topic is something which we live every day in and out. And so I'm happy to be here with my co-panelists to share my perspectives.
Fantastic. Thank you so much, Stephen.
Good morning, good afternoon. Thank you all, Eliot and the Super Return team. My name is Steve Cowan. I'm a co-founder and managing director of 57 Stars, which is an asset manager focused on venture and growth investing, primarily in markets outside the United States and Western Europe. So broadly speaking, in emerging markets, we manage just under $5 billion and invest globally out of offices around the world. Thanks. And maybe I should also preface by saying, perhaps ironically, for a session on communication, my audio is exceptionally bad. So if I apologize if I am either very slow to respond or if I answer a topic that's entirely different from what the rest of the panel is talking about.
Steve, thank you so much. Really appreciate it. Well, listen, first question here is for Alison. Why don't you take us back to March of last year? COVID hits. How is the GP-LP relationship immediately impacted by the pandemic?
Yeah, it seems like a lifetime ago, and also only yesterday, when we were thrown into our homes with a few hours notice. Please work from home starting tomorrow. And immediately the questions began to come from all of our internal stakeholders and our external stakeholders. What does this mean for our portfolio? What does this mean in the markets? Fortunately, the GPs were equally inspired to reach out to us and to share that information. So I would describe the first couple of months really as a flurry of activity, with the GPs providing updates, first of all, on the sort of health and safety measures they were taking for their own staff, and then the portfolio companies to respond to the pandemic, to limit the infection risk and so on. And then with the financial impacts on the portfolio. Then with trying to anticipate and be prepared for the requests for new capital or for flexibility in existing fund agreements to accommodate any kind of short-term capital requirements of the portfolio. So it was definitely a time to intensify contact and as I say, accelerate in terms of frequency from the quarterly updates to much more frequent contact.
Kamal and Steve, did you guys experience the same thing or slightly different?
Yeah,
I'm sorry. Go ahead, Kamal.
No, Steve, go ahead.
No, I was going to say yes. I think it was largely the same for us in many respects. Although it was, to my mind, surprising how quickly we and most of the rest of the world with whom we worked adapted and shifted and have managed to take advantage of the new world. And I guess this conference is a great example of that. There are obviously a lot of disadvantages, but there are quite a few advantages in terms of the breadth of people and times that you can do things, as well as obviously shortening commutes and reducing the amount of time we're spending on airplanes. But definitely agree with Alison about the sort of the pattern and flow from the beginning to today.
Kamal?
Yeah, I would concur with both Steve and Alison that it was a year of sorts, and it was a whirlwind of activity, and it was when right from the time that the pandemic broke out, people were on a roller coaster. And if I have to use one word to kind of describe overall sentiments, it is that most LPs were really overwhelmed with all that transpired throughout the course of the year. First, it was trying to get wrap their heads around valuations and exposures. I remember getting a call from a state pension plan wanting to do a deep dive on what exposures they had, even though they had all different kinds of experts on staff as well as external resources. But people were really overwhelmed with that situation. And then we had a summer of unrest, which brought to the fore a lot of burning issues of social inequality and diversity and climate. And as that gained momentum and we moved into the fall, topics of conversation revolved around, the advent of the vaccine, the political situation in the US, getting some clarity on that note. And things started looking up until this year when we were again grappling with inflation, as well as, all new actors and phenomena in the marketplace, right from SPACs to Bitcoins and everything else that kept people really on their toes as to what was happening. So it was, I would say, very overwhelming, and people really failed to, I would say, failed is maybe a strong word, but people were drawing a pause to gather conviction around ideas. And as a result, they started gravitating more towards established relationships, and newer relationships became a problem.
And Kamal, really interesting to see that, people are just, there's this overwhelming need for information and then trying to identify a path forward. I'd love your input on, how did LPs or even fund managers respond? And if you could specifically talk about, either new technologies or existing technologies that were leveraged in new and exciting ways, I'd love to sort of hear your perspective on that.
Yeah, I mean, actually, technology has played a big role. It's been a manna from heaven. We've seen a lot of technology platforms come to the fore, offering detailed insights into exposures. There's a lot that has happened, where platforms have mushroomed in the private market space, where exposures are more difficult to gather. So people are trying to provide like one-stop solutions. There are quite a few vendors out there that have started kind of bringing new solutions to LPs, so that, God forbid, if we have another situation like this, people at the click of a button can know what is it that they own and what are some overlapping and concentrated exposures, because that was actually the most pressing issue with the outbreak of the pandemic. And I would say, GPs have become definitely, they stepped up to the plate. They became more responsive. There were a lot of constant updates. However, on the flip side, LPs were really overwhelmed, again, to use that term, to field all those Zoom calls. Like they're only 24 hours a day. And agreed, LPs are perhaps more available behind their screens, but by the same token, they are really consumed by all that is happening and to keep up with the ongoing developments. So there was an information overload, I would say, but technology definitely was an enabling factor. And I think it has made its case that going forward, people need to get adopt digital solutions, whether it be just keeping up with information, whether it is managing exposures, or for that matter, even due diligence.
Mm-hmm. Alison, any cool technologies or new innovations that you guys came up with or implemented at FMO?
Yeah, I do want to share one. I do also want to just react first to what Kamal said about digital overload, because I think we've all sort of adapted to doing a lot of our meetings online, and it may be much more efficient actually, because you don't need to travel and because you can book half-hour back-to-back slots with virtually no turnaround time. I wonder if that's sustainable, and it's not only that seeing people in person is more pleasant, or that maybe you can judge someone or interactions between a team better when you're in the same place, but also that's more the pace of human ability to process information. So I'm not fully convinced of the all digital approach. The one thing which we did, I'd have to say pilot, but probably in two different settings over the past year, was remote due diligence on an operating company. And in both cases, it was with a local partner. So I don't want anyone to get the idea that we're investing in companies that we've never seen or visited. But when we have a fund manager that's based locally, in one case, we knew the executives of the company quite well already. In the other case, they were well known to the GP for years. But we weren't able to go in person to visit those companies with our investment team. And yet we did proceed with due diligence and with the commitment to invest. Using a combination of Zoom interviews, yes, but also GoPro technology. And so one example is a microforestry company where some of the team on the ground went around and looked at the assets and looked at the manufacturing facilities, with our team sort of watching remotely from the Netherlands. I think one observation from an earlier conversation, you might think remote due diligence is more efficient. It's not. It takes a lot more time to ask the same questions to the same people when you're doing it remotely, but we did manage to find some ways to make up for not being able to physically visit the operations. I
love it. Stephen, are you guys using GoPro cameras for due diligence these days?
Not yet, but gee, that's a great idea. I think similarly, tempted to say everyone, but obviously it's not everyone. It's actually a minority of the world's population. But like everyone involved in this conference, we are using Zoom and like for almost everything. And so, yes, technology has played a very significant role in things we do. I think that one of the impacts of this is that it has tended to push people toward things that are already within their universe. As Alison said, in making a co-investment in something that's already in our portfolio, or something where the GPs with whom we're working are currently engaged, is quite comfortable, and we've done it to very, very successful effect. and we think we have a real advantage vis-a-vis some others in the depth of and breadth of relationships we have with our partners around the world. But I do think that what you have witnessed, and I think Kamal referred to it, is that there has been a very strong bias over the last 18 months in an exceptionally strong fundraising environment for a huge proportion of that capital to go to large and established firms, and it has had a very, very negative impact on the smaller, newer, less institutionally well-known names and firms, and so that you have a further bifurcation, distortion in the allocation of capital globally.
Interesting. I mean, that's sort of my one big question is, yeah, how has that balance been upset between the emerging fund manager and the established one? And I'd be sort of curious to hear from the panel, like, I mean, do we have any insight into how emerging fund managers are coping during this period? Is there anyone, are they sort of unilaterally sort of quote unquote hurting, or have some of them managed to adopt and even thrive in this environment?
I'll take a stab at that because I can very much empathize with many of the emerging managers. I mean, they are definitely getting the short end of the stick, say the least, because logistically it's just impossible for them to get in front of any LPs, and LPs can only do so many calls, and then if you don't have if your voice is getting lost in the crowd, even though you might have some very compelling pockets of opportunities that you are well positioned to tap into. However, LPs, for their own reasons, like 50, different surveys show almost 50% of LPs will not want to do business with anyone that they can't meet in person or go on site to get satisfied and meet with the managers. So some LPs, some GPs have tried to kind of reposition themselves, adopting some what I would call digital pitch book approaches, where they've engaged with some companies to do 10-15 minute videos. But as one LP, I recall telling me that a pitch book is a pitch book, whether it is in paper format or in digital. What we need is information that we can process really easily, and that becomes a big stumbling block when there is so much coming at you, not only just from managers, but from the environment, right? There's just so much in a state of flux right now. For example, distressed debt, which has raised gobs and gobs of money. Now, some of the marquee names did kind of rake in a lot of money, but then the problem now is, as today's private debt investors reports, they're not finding a home because of all the rescue and forbearance that central banks have imparted. So long story short, I think this is will be an ongoing struggle for smaller managers as long as we are in this virtual world. But I think this is a necessity. Creates a compelling the situation creates a compelling need for being creative, and I think emerging managers will need to kind of think outside the box.
I'd say that just to be clear, I mean, from our perspective, this is quite an interesting environment for that reason, right? That there's a relative dearth of capital in areas that we think are very, very compelling, and so we've sought to take advantage of it. And one of the ways, to your question on how less institutional or less well-known managers are seeking to move through the crowd and make their voices heard is through structured transactions or preferred rights in certain ways. So one of the things, about 85% of what we're investing in anyway are structured deals as opposed to, blind pool 2 and 20 funds. And so what I mean by that is offering a co-investment or a secondary or preferred terms of some kind, so that that is, I think, had become fairly common prior to the pandemic, but it is increasingly what we're seeing increasingly is that GPs will put together a structure particularly to try to attract relatively larger LPs and those who are interested in co-investment or other structured transactions. That's one answer to how they're coping.
Interesting. Alison, do you have any additional perspective there?
I would say it's never easy to be a first-time manager, but certainly the past year has made it more difficult. There was a pre-con presentation a bit earlier today showing that the average time to closing for the frontier markets, which is a subset of emerging markets in my view, was up to 42 months. That's really long. That's 3.5 years. But that being said, there were then apparently funds that closed after 42 months on average. So some were longer. So I think it's always been a game for the committed who genuinely have a good story to sell that's differentiated, that's compelling to the right LPs. So I'd say don't give up, but also start early. We did close an investment with a first-time fund manager this year. Team that's worked together before with a relevant track record, and that had engaged with us, before COVID hit. And so, if you start to establish those connections when you can, that also creates more runway to sort of go through the rest of the process online. The other sort of observation I would make, which feels very old school, but I think don't underestimate the relevance of introductions. Right, that you might think in the all digital world, then reaching out. I've had interesting cold calls on LinkedIn, and I've had interesting cold calls through info@fmopen.nl. But when someone introduces you, that also gives a little bit of an extra hook. So I think old school sometimes also has a reason for the historical success as well.
Well, that's the perfect time to announce the result of our poll, and which I think is going to be quite interesting and perhaps reflective of the newfound optimism here. Will in-person meetings ever return to the deal process? And I kid you not, but 100% of basically everyone said yes, they will be back to the deal cycle. Nobody voted no or not sure. Any reactions to that?
Yeah, I would say yes. There is definitely, you can't totally eliminate human interaction or the social aspect of deal making, which has stood the test of time, and it's second nature to us. But I think given the virtues of being in the virtual world, which is saving on time as well as saving on costs, that of running an operation, I think perhaps it'll be a hybrid or a blend of adopting some virtual technologies in conjunction with doing in-person deals, where I think more of the upfront work or the introductions, as Alison alluded to, perhaps that can take place more virtually. And then doing a lot of the grunt work, a lot of the due diligence, something that I think, again, Alison hit on, that remote due diligence is perhaps not as effective. And I would say that, yes, it makes it a lot more challenging. But if one can, front load a lot of the work that you would probably do at an on-site, if back in the day, then that due diligence in person, when you actually get down to doing so, is that much more effective. Right, where that is not, where the due diligence on site is not a fact-finding mission, but it is more a verification exercise and a validation exercise. So I think yes, we will see reverting back to human interaction, but probably carrying with us the benefits of this virtual adaptation that we've been used to in the last 1 year.
Steve, do you have any perspective on what parts of the process might be brought back offline?
I suspect the vast majority will go back, if and when we can, to in person. Having said that, obviously we've learned a tremendous amount about the efficiencies we can gain, and we had been using video for a fair amount of work, both internally and externally, before the pandemic. And there's absolutely no question in my mind that that is going to, what we're doing today will continue in large measure for some things. But I still think that whether we're right about it or wrong about it, I think people feel as though they get a tremendous amount out of in-person meetings and the ability to be in the room and witness actual body language. And as I say, we may be wrong in our belief that that's important in our judgment, but I think that it absolutely is going to happen, and relatively soon. I mean, we're starting to get requests from GPs for in-office meetings, and again, it also depends where in the world you are. In our Beijing office, has been back to business more or less as usual for months.
Fantastic. We've got 1 more minute left. Wanted to quickly put on our prediction hats. How is the GP-LP relationship going to evolve over the next 10 years? Everyone give sort of one example that they might come up with. Alison?
I think potentially fewer, closer, deeper relationships.
Kamal?
I would say as we've implemented, we share our introductory calls with LPs, recorded sessions for LPs to kind of actually get a feel for the manager. So that's a practical implementation, and we plan to kind of now share on-sites, virtual on-sites with LPs as well.
Fantastic. Steve, last word.
Well, I think there's a move toward both greater transparency and more standardization across the asset class, and I think that will continue and expand. And I think both of them are a great thing. Transparency, I think, is very important for LPs as well as GPs, and standardization is just going to make all of our lives much more efficient and productive.
Well, that's a future that I think everyone can look forward to. Well, thank you very much, everyone. And a big thanks to our wonderful panelists for all their insight. And Tatiana, back to you.